So yeah, this is day 4 of the series. Today we're going to be covering 1.7, the financial crisis of 2008. This is my favorite topic to talk about in finance and the history of finance, because I covered it in my 12th grade economics project. So yeah, um, let's just start. Yeah. This chapter has laid out the broad outlines of the financial system, as well as some of the links between the financial side of the economy and the real side, in which goods and services are produced. The financial crisis of 2008 illustrates in a painful way the intimate ties between these two sectors. We present in this section a capsule summary of the crisis, attempting to draw some lessons about the role of the financial system as well as the causes and the consequences of what has become known as systemic risk. Some of these issues are complicated. We consider them briefly here, but will return to them in greater detail later in the text, once we have more context for analysis. Antecedents of the crisis. In early 2007, most observers thought it inconceivable that within 2 years the world financial system would be facing its worst crisis since the Great Depression. At the time, the economy seemed to be marching from strength to strength. The last significant macroeconomic threat that had been from the implosion of the high-tech bubble in 2000-2002. But the Federal Reserve responded to an emerging recession by aggressively reducing interest rates. Figure 1.1 shows that Treasury bill rates have dropped drastically between 2001 and 2004, and the LIBOR rate, which is the interest rate at which major money center banks lend to each other, fell in tandem. These actions appeared to have been successful, and the recession was short lived and mild. By mid decade, the economy was apparently healthy once again, although the stock market had declined substantially between 2001 and 2002. Figure 1.2 shows that it reversed direction just as dramatically beginning in 2003, fully recovering all of its post-tech meltdown losses within a few years. Of equal importance, the banking sector seemed healthy. The spread between the LIBOR rate at which banks borrow from each other and the Treasury bill rate at which the US government borrows, a common measure of credit risk in the banking sector, often referred to as the TED spread, was only around 0.25% in the early 2007. See the bottom curve in figure 1.1, suggesting that fears of default or counterparty risk in the banking sector were extremely low. Indeed, the apparent success of monetary policy in the recession, as well as in the last 30 years more generally, had engendered a new term, the Great Moderation, to describe the fact that recent business cycles and recessions in particular seemed so mild compared to past experience. Some observers wondered whether we had entered a golden age for macroeconomic policy in which the business cycle had been tamed. LIBOR stands for, as we had talked about before, or I don't know if you've talked about it before, I actually don't know. The London Interbank Offer Rate. It is a rate charged in an interbank lending market outside of the US, largely centered in London. The rate is typically quoted for 3-month loans. TED stands for Treasury Euro-Dollar Spread. The euro-dollar in this spread is in fact LIBOR. So the TED rate is the difference between the LIBOR rate and the Treasury bill rate at which the US government borrows. So as we can see, this is figure 1.1, and in this figure, this is, I don't know which year this is actually, early 2007. Yeah, so this is the year 2007, going from January to July, and as we can see, there's a huge drop here around July 1st. Oh no, these are multiple years. So this is going from the year 2000 to the year 2016. So this is a 16-year time span. And as we can see in from January, January 2002 to July 2005-ish, there was a huge drop in the LIBOR rate, the T-bill rate, and the TED spread. So TED spread is the black line, and the others are the LIBOR and the T-bill rate. So during 2002 and 2005, in the 3 years then, there was a huge drop in these rates. So basically what this is saying is that the fears of default, basically what this is saying is that during this time the rates had dropped so much because the fear and the risk in the banking sector had also dropped. So if the market is considerably less volatile and is like relatively stable and stuff, people won't want to like invest in safer assets, because they will be more like risk tolerant. They'll be more outward looking in the sense that they don't want to invest all their money in a safe like T-bill because the market is volatile. Because during this time the market was not volatile, or at least it didn't seem so. So that's why people do not want to invest in debt securities, which were way safer than equity securities, right? As we already know. And because of that, since the demand was low, therefore the rates for these bills also considerably dropped during this time. So we're just seeing that in this chart. And figure 1.2, where is it? Yeah, figure 1.2 is the cumulative returns on the S&P 500 index. This is from 1980 to 2016, when I assume the book was finished or written, like the data was up to date. So as we can see, there was a dip in around 2002-ish. I assume that's the dot-com bubble. And then 2008, that was a financial crisis. So on and so forth. And as we can see, there's a little, I don't know if you can see that clearly, but there's a little bump drop here as well in around 1987. That was known as the Black Thursday, I think, if my memory serves me right. It was 1987, the stock market crashed heavy, and that's that little bump over there. This I assume is the dot-com bubble crash. Couldn't be anything else. I don't think so. Maybe 9/11 also impacted in it. So yeah. Anyways, moving forward, the combination of dramatically reduced interest rates and an apparently stable economy fed a historic boom in the housing market. Figure 1.3 shows that US housing prices began rising noticeably in the late 1990s and accelerated dramatically after 2001 as interest rates plummeted. In the 10 years beginning in 1997, average prices in the US approximately tripled. But the newfound confidence in the power of macroeconomic policy to reduce risk, the impressive recovery of the economy from the high-tech implosion, and particularly the housing price boom following the aggressive reduction in interest rates, may have sown the seeds for the debacle that played out in 2008. On one hand, the Fed's policy of reducing interest rates had resulted in low yields on a wide variety of investments, and investors were hungry for high-yielding alternatives. On the other hand, low volatility and optimism about macroeconomic prospects encouraged greater tolerance for risk in the search for these high-yielding investments. Nowhere was this more evident than in the exploding market for securitized mortgages. The US housing and mortgage finance markets were at the center of a gathering storm. So this is the Case-Shiller Index of US housing prices. I'm assuming the Shiller in this means Robert Shiller. But so figure 1.3 shows the housing prices were rising noticeably late 1990s and then dramatically accelerated after 2001 as interest rate plummeted. So as we can see from this diagram, it's from 1990 to 2016. So it was increasing like steadily till the year 2001, and then from 2001 it like accelerated greatly till about 2005 6, and then it peaked 2006, and then 7 and 8 it fell drastically. So yeah, that is the Case-Shiller index of US housing prices. And that was that. And then now we're gonna move into changes in housing finance. Prior to 1970, most mortgage loans would come from a local lender, such as a neighborhood savings bank or credit union. A homeowner would borrow funds for a home purchase and repay the loan over a long period, commonly 30 years. A typical thrift institution would have as its major asset a portfolio of these long term loans, while its major liability would be the accounts of its depositors. This landscape began to change when Fannie Mae (FNMA) or Federal National Mortgage Association and Freddie Mac (FHLMC) or Federal Home Loan Mortgage Corporation began buying mortgage loans from originators and bundling them into large pools that could be traded like any other financial asset. These pools, which are essentially claims on underlying mortgages, were soon dubbed mortgage-backed securities, and the process was called securitization. Fannie and Freddie quickly became the behemoths of the mortgage market, between them buying around half of all mortgages originated by the private sector. Figure 1.4 illustrates how cash flows uh, passed from the original borrower to the ultimate investor in a mortgage-backed security. The loan originator, for example, the savings and loan, might take a $100,000 home loan to a homeowner. The homeowner would repay principal and interest (P&I) on the loan over 30 years. But then the originator would sell the mortgage to Freddie Mac or Fannie Mae and recover the cost of the loan. The originator could continue to service the loan, collect monthly payments from the homeowner for a small servicing fee. But the loan payments, net of that fee, would be passed along to the agency. In turn, Freddie or Fannie would pool the loans into mortgage backed securities and sell the securities to investors such as pension funds or mutual funds. The agency, Fannie or Freddie, typically would guarantee the credit or default risk of the loans included in each pool, for it would retain a guarantee fee before passing along the rest of the cash flow to the ultimate investor. Because the mortgage cash flows were passed along from the homeowner to the lender to Fannie or Freddie to the investor, the mortgage-backed securities were also called pass-throughs. Until the last decade, the vast majority of securitized mortgages were held or guaranteed by Freddie Mac or Fannie Mae. These were low-risk conforming mortgages, meaning that eligible loans for agency securitization couldn't be too big, and homeowners had to meet underwriting criteria establishing their ability to repay the loan. For example, the ratio of loan amount to house value could be no more than 80%. But securitization gave rise to a new market niche for mortgage lenders, the originate to distribute versus originate to hold business model. Whereas conforming loans were pooled almost entirely through Freddie Mac and Fannie Mae, once the securitization model took hold, it created an opening for a new product, securitization by private firms of non-conforming subprime loans with higher default risk. One important difference between the government agency pass-throughs and these so-called private label pass-throughs was that the investor in the private label pass-through pool would bear the risk that homeowners might default on their loans, thus originating mortgage brokers had little incentive to perform due diligence on the loan as long as the loans could be sold to an investor. These investors, of course, had no direct contact with the borrowers and they could not perform detailed underwriting concerning loan quality. Instead, they relied on borrowers' credit scores, which steadily came to replace conventional underwriting. A strong trend toward low documentation and no documentation loans, entailing little verification of a borrower's ability to carry a loan, soon emerged. Other subprime underwriting standards quickly deteriorated. For example, allowing leverage on home loans as measured by the loan to value ratio rose dramatically. By 2006, the majority of subprime borrowers purchased houses by borrowing the entire purchase price. So it was no longer 80%. Now they could borrow 100% of the house price. When housing prices began falling, these loans were quickly underwater. meaning that the house was worth less than the loan balance, and many homeowners decided to walk away from their loans. Adjustable rate mortgages, ARMs, also grew in popularity. These loans offered borrowers low initial or teaser interest rates, but these rates eventually would reset to current market interest yields. For example, the Treasury bill rate plus 3%. Many of these borrowers maxed out their borrowing capacity at the teaser rate. Yet, as soon as the loan rate was reset, their monthly payments would soar, especially if market interest rates had increased. Despite these obvious risks, the ongoing increase in housing prices over the last decade seemed to lull many investors into complacency, with a widespread belief that continually rising home prices would bail out poorly performing loans. But starting in 2004, the ability of refinancing to save a loan began to diminish. First, higher interest rates put payment pressure on homeowners who had taken out adjustable rate mortgages. Second, as figure 1.3 shows, housing prices peaked by 2006, so homeowners' ability to refinance a loan using built up equity in the house declined. Mortgage default rates began to surge in 2007, as did losses on mortgage backed securities. The crisis was ready to shift into high gear. So, what we just read there was the core problem that resulted eventually in the crisis that would follow, right? So we saw that people were becoming complacent and basically they were giving out loans to anybody who would take them, simply because even if they could not pay, the rising house value uh, would cover the losses and result in profits anyways. So everybody became complacent. Everybody was taking the houses at the teaser rates, but then when they couldn't afford it anymore, uh, they got evicted, and so yeah, this was the whole toxic, vicious cycle that led to the financial crisis of 2008. And now, as we can see in this diagram, figure 1.4, we see cash flows in a mortgage pass-through security. So this is what we talked about. So basically, you have a guy, a homeowner, right? He wants to own a home, and to own a home, he has to borrow money. He has to take on a home loan. Okay, so he takes on a home loan from an originator. Okay, and let's say he borrows $100,000 for the home. So he borrows that, and then he's paying the principal and interest to and from the originator. So now the originator is not interested in holding this loan for 30 years because that's too long and it's not financially viable for the originator to wait 30 years for 100,000 to be paid back with interest. That's just too long, and it's not financially viable, and it's not like a smart thing. It's not a good business model for the originator to have. So what the originator does is that he pawns off however many local or regional home loans that they might have to an agency, which is a bigger sort of a bigger house, a bigger bank, or something like that, right? And the agency has hundreds or thousands of these originators from maybe all across the country or all across many several states that pawn these home loans off to them. In return for this, the originator gets a small service fee. So that is what they're getting out of the whole ordeal, anyways. So then the agency now has all these different home loans that these homeowners are paying the principal and interest back to over the course of 20 and 30 years. Now, what the agency does is that the agency bundles up all these different mortgages and turns them into an asset, which is known as the mortgage backed security, which was invented in the 1980s by, I don't remember the name, but yeah, it was. So they package and bundle up all these mortgages into a MBS, a mortgage backed security, and then they sell that security, like a portion of it or even completely the whole of the security, to investors who invest in a security based on the credit ratings of the people who have taken on the mortgages that are bundled up in that MBS, in that security. So this is how the cycle works. So the homeowner gets the home, has to pay the principal and interest. The originator gets a servicing fee and has to pawn off the loan to the agency. The agency gets uh, the servicing guarantee fee, and the investor gets his appropriate share of the principal and interest that the homeowner is paying, or that thousands of homeowners are paying. So this is how an MBS is made, and this is how the system works. Now this is a good system, and it does work. It still is working, but this only works if the homeowners involved actually pay back their principal and interest, what they owe. But if all of a sudden they stop paying back, all of them, most of them start defaulting, this whole system falls apart because this whole chain breaks. There's no PNI being transferred, so there's no point in having this chain in the first place. So that is the um, you know MBS securitization food chain sort of explained. And this is a very long part, but let's just finish it. I'm sure we'll be, yeah, actually this is like one of the last parts of this chapter, so that's good. Yeah, now we're gonna do mortgage derivatives. One might ask, who was willing to buy all of these risky subprime mortgages? Securitization, restructuring, and credit enhancement provide a big part of the answer. New risk shifting tools enabled investment banks to carve out AAA rated securities from the original issue junk loans. Collateralized debt obligations, or CDOs, were among the most important and eventually damaging of these innovations. CDOs were designed to concentrate the credit, i.e., the default risk of a bundle of loans on one class of investors, leaving the other investors in the pool relatively protected from that risk. The idea was to prioritize claims on loan repayments by dividing the pool into senior versus junior slices, called tranches. The senior tranches had first claim on repayments from the entire pool. Junior tranches would be paid only after the senior ones to the senior tranche, and 30% allocated to the junior one. The senior investors would be repaid in full as long as 70% or more of the loans in the pool performed. That is, as long as the default rate on the pool remained below 30%, even with pools composed of risky subprime loans, default rates over 30% seemed extremely unlikely, and thus senior tranches were frequently granted the highest AAA rating by major credit rating agencies that are Moody's, Standard & Poor's, and Fitch. Large amount of AAA rated securities were thus carved out of pools of low rated mortgages. We will describe CDOs in more detail in chapter 14. Of course, we know now that these ratings were wrong. The senior subordinated structure of CDOs provided far less protection to senior tranches than investors anticipated. When housing prices across the entire country began to fall in unison, defaults in all regions increased, and the hoped for benefits from spreading the risks geographically never materialized. Why are the rating agencies so dramatically underestimated credit risk in these subprime securities? First, default probabilities had been estimated using historical data from an unrepresentative period characterized by a housing boom and an uncommonly prosperous and recession free macroeconomy. Moreover, the rating analysts had extrapolated historical default experience to a new sort of borrower pool, one without down payments, with exploding payment loans, and with low or no documentation loans, often called liar loans. Past default experience was largely irrelevant given these profound changes in the market. Moreover, the power of cross regional diversification to minimize risk engendered excessive optimism. Finally, agency problems became apparent. The ratings agencies were paid to provide ratings by issuers of securities, not the purchasers. They faced pressure from the issuers who could shop around for the most favorable treatment to provide generous ratings. Concept check. When Freddie Mac and Fannie Mae pooled mortgages into securities, They guaranteed the underlying mortgage loans against the homeowner's defaults. In contrast, there were no guarantees on mortgages pooled into subprime mortgage-backed securities, so investors were the one to bear the credit risk. Were either of these arrangements necessarily a better way to manage and allocate default risk? So I believe the Fannie Mae and Freddie Mac way is better to allocate default risk, because in a subprime mortgage-backed securities, the investors are the one to bear all the risk. So if the default rates in this case exceed 30%, which they did, the investors have to pay and have to bear the risk that comes along with that. So yeah, now we move on to credit default swaps. So this is the main concept, and that's why I like so much, because a lot of movies, especially The Big Short, which is about Michael Burry, who made around $800 million because of the financial crisis, because he saw it coming years before. And he invented, I don't know if he invented, but in the movie it said that he did. He invented like credit default swaps. So credit default swaps are basically like insurance against the housing market. Essentially, that is pretty much what it is. It's like if somebody else's house burns down, or if somebody else has a car accident, and you have bought an insurance and you believe that they will have an accident or their house will burn down, and because of that you bought insurance against it, and when it actually happens, you get a payoff, you get a payout. So that's essentially what credit default swaps are. And what we talked about before here in the mortgage derivatives and the AAA ratings and so on and so forth, basically they were talking about like the rating agencies like Moody's, Fitch, and S&P. They were basically bribed to give all these, firms good ratings on their subprime MBS and CDOs, so that investors would trust their ratings and invest. And they would want to say that they were victims, but they honestly weren't. They could have held their ground and lost clients and prevented this whole thing, but they didn't. They gave in. They gave in to the bribes. They gave in to the threats. So that's how it happens. And anyways, yeah. Now we move on to credit default swaps. In parallel to the CDO market, the market in credit default swaps also exploded in this period. A credit default swap, or a CDS, is in essence an insurance contract against the default of one or more borrowers. We will describe these in more detail in chapter 14. The purchase of the swap pays an annual premium, like an insurance premium, for protection from credit risk. Credit default swaps became an alternative method of credit enhancement, seemingly allowing investors to buy subprime loans and ensure their safety. But in practice, some swap issuers ramped up their exposure to credit risk to unsupportable levels without sufficient capital to back those obligations. For example, the large insurance company AIG, American Insurance Group, alone sold more than $400 billion of CDS contracts on subprime mortgages. Now we have a footnote right there. CDOs and related securities are sometimes called structured products. Structured means that original cash flows are sliced up and reapportioned across tranches according to some stipulated rule. So yeah, it's basically taking out an insurance against the housing market. Essentially, that's what it is, and you have to pay a annual premium, which obviously is the trade-off. So yeah, now we move on to the rise of systemic risk. By 2007, the financial system displayed several troubling features. Many large banks and related financial institutions had adopted an apparently profitable financing scheme, borrowing short term at low interest rates to finance holdings in higher yielding long term illiquid assets. and treating the interest rate differential between their assets and liabilities as economic profit. But this business model was precarious. By relying primarily on short term loans for their funding, these firms needed to constantly refinance their positions, that is, borrow additional funds as the loans matured, or else face the necessity of quickly selling off their less liquid asset portfolios, which would be difficult in times of financial stress. Moreover, these institutions were highly leveraged and had little capital as a buffer against losses. Large investment banks on Wall Street, in particular, had sharply increased leverage, which added to an underappreciated vulnerability to refunding requirements, especially if the value of the asset portfolios came into question. Even small portfolio losses could drive their net worth negative, at which point no one would be willing to renew outstanding loans or extend new ones. Another source of fragility was widespread investor reliance on credit enhancement. Through products like CDOs, many of the assets underlying these pools were illiquid, hard to value, and highly dependent on forecasts of future performance of other loans. In a widespread downturn with rating downgrades, these assets would prove difficult to sell. This new financial model was brimming with systemic risk, a potential breakdown of the financial system when problems in one market spill over and disrupt others. When lenders such as banks have limited capital and are afraid of further losses, they may rationally choose to hoard their capital instead of lending it to customers such as small firms, thereby exacerbating funding problems for their customary borrowers. The shoe drops. By fall 2007, housing price declines were widespread. Figure 1.3, mortgage delinquencies increased and the stock market entered its own free fall. Figure 1.2. Many investment banks, which had large investments in mortgages, also began to totter. The crisis peaked in September 2008. On September 7th, the giant federal mortgage agencies Fannie Mae and Freddie Mac, both of which had taken large positions in subprime mortgage-backed securities, were put into conservatorship. We will have more to say on their troubles in chapter 2. The failure of these two mainstays of the US housing and mortgage finance industries threw financial markets into a panic. By the second week of September, it was clear that both Lehman Brothers and Merrill Lynch were on the verge of bankruptcy. On September 14th, Merrill Lynch was sold to Bank of America, again with the benefit of government brokering and protection against losses. The next day, Lehman Brothers, which was denied equivalent treatment, filed for bankruptcy protection. 2 days later, on September 17th, the government reluctantly lent $85 billion to AIG, reasoning that its failure would have been highly destabilizing to the banking industry, which was holding massive amounts of its credit guarantees, CDS contracts. The next day, the Treasury unveiled its first proposal to spend $700 billion to purchase toxic mortgage-backed securities. A particularly devastating fallout of the Lehman bankruptcy was on the money market. For short term lending, Lehman had borrowed considerable funds by issuing very short term debt called commercial paper. Among the major customers in commercial paper were money market mutual funds, which invest in short term, high quality debt of commercial borrowers. When Lehman faltered, the Reserve Primary Money Market Fund, which was holding large amounts of AAA rated Lehman commercial paper, suffered investment losses which drove the value of its assets below $1 per share. Fears spread that other funds were similarly exposed, and money market fund customers across the country rushed to withdraw their funds. The funds, in turn, rushed out of commercial paper into safer and more liquid treasury bills, essentially shutting down short term financing markets. The freezing up of credit markets was the end of any dwindling possibility that the financial crisis could be contained to Wall Street. Larger companies that relied on commercial paper market were now unable to raise short-term funds. Banks similarly found it difficult to raise funds. Look back to figure 1.1, where you will see that the debt spread, a measure of bank insolvency fears, skyrocketed in 2008, with banks unwilling or unable to extend credit to their customers. Thousands of small businesses that relied on bank lines of credit also became unable to finance their normal business operations. Capital starved companies were forced to scale back their own operations precipitously. and the unemployment rate rose rapidly, and the economy was in its worst recession in decades since the Great Depression. The turmoil in the financial markets had spilled over into the real economy, and Main Street had joined Wall Street in a bout of protracted misery. The crisis was not limited to the United States. Housing markets throughout the world fell, and many European banks had to be rescued by their governments, which were themselves heavily in debt. As the cost of the bank bailouts mounted, the ability of these governments to repay their own debts came into doubt. In this way, the banking crisis spiraled into sovereign debt crisis. Greece was the hardest hit. Its government debt of about $460 billion was considerably more than its annual GDP. In 2011, it defaulted on debts totaling around $130 billion, despite a series of rescue packages from the European Union and the European Central Bank and the IMF, the International Monetary Fund. It was still on shaky ground in 2016. So we talked about this is the climax. This is when the shoe drops appropriately, and we saw that people were scrambling. People were trying to save it. People were trying to contain it, but it couldn't be contained anymore, and it spilled over to the real economy, to Wall Street, and also internationally, and created a world economic crisis never seen before in decades. So now we move on to the Dodd-Frank Reform Act. So this is done by Obama in his efforts to prevent anything remotely close to this happening ever again. So the Dodd-Frank Reform Act. So yeah, the crisis engendered many calls for reform of Wall Street. This eventually led to the passage in 2010 of the Dodd-Frank Wall Street Reform and Consumer Protection Act, which proposes several mechanisms to mitigate systemic risk. The act calls for stricter rules for bank capital, liquidity, and risk management practices, especially as banks become larger and their potential failure will be more threatening to other institutions. With more capital supporting banks, the potential for one insolvency to trigger another one could be contained. In addition, when banks have more capital, they have less incentive to ramp up risk, as potential losses will come at their own expense and not the FDIC's. Dodd-Frank also attempts to limit the risky activities in which banks can engage. The so-called Volcker Rule, named after the former chairman of the Federal Reserve, Paul Volcker, prohibits banks from trading for their own accounts and limits total investments in hedge funds or private equity funds. The Act also addresses incentive issues. Among these are proposals to force employee compensation to reflect longer term performance. For example, public companies must set clawback provisions to take back executive compensation if it was based on inaccurate financial statements. The motivation is to discourage excessive risk taking by large financial institutions in which big bets can be wagered, with the attitude that a successful outcome will result in a big bonus, while a bad outcome will be borne by the company or worse, the taxpayer. The incentives of the bond rating agencies are also a sore point. Few are happy with the system that has the rating agencies paid by the firms they date. The Act creates an Office of Credit Ratings within the Securities and Exchange Commission to oversee the credit rating agencies. It is still too early to know which, if any, of these reforms will stick. The implementation of the Dodd-Frank Act is still subject to considerable interpretation by regulators, and the Act is still under attack by some members of Congress. But the crisis surely has made clear the essential role of the financial system in the functioning of the real economy. So that was the financial crisis of 2008 that we studied right now, and we covered a lot of topics. We went through the whole thing from 2000 2010 11, and yeah, that was a good session. That was a good video. That was a good read, and in the next part we will finish this chapter. We will cover 1.8 and the summary, and we will start doing the questions for this chapter as well. So I still don't know how I will show doing the questions, because I don't know, maybe, I don't know, you know what, maybe I'll write it and I'll like talk about it, but I won't like write the long answers because that'll take a lot of time. So any answers which require any calculations, I'll write on paper. But except that, I think I'll just like talk about it. And yeah, that's pretty much it for today. Yeah, thanks for watching.